Welcome back, everyone. With Q1 earnings season now by and large in the books, I'm going to go through the public portfolio and talk about any notable earnings updates that I've seen. Now, I do want to clarify that mostly earnings are just a short-term snapshot or report card, and I rarely trade off of earnings or am owning a stock because I want it to break through on earnings and then sell it right after. So in general, I'd prefer to hold investments longer term, probably forever, except some investments aren't made that way. They're cyclical or things start going subpar or some type of thing like that. But anyway, this is just snapshot assessment and not final judgment on a company. Melcor, overall, I felt had a rather decent to good quarter. Now, looking at the stock recently, I was probably expecting that, but there was strength, there was growth in the gross leasable area division, there was the lot sales more than doubled, and a lot of inventory added to the active development pipeline. I think the home building sector across North America still has some longer term runway. Whether that'll show up in a straight line or more jagged, I don't know. But Melcor still trades at 40% of book, and while on a price to FFO basis, it's less super cheap, I still don't think it's expensive by any stretch of the imagination, and I think that the market still discounts that sector, or that space, that geography, if you will, due to oil risk. But as we go along, as new industries kind of pop up and as things recover, I'm less and less sure that it should discount the region due to oil risk, because I don't think oil is necessarily going to be the only driving factor there forever. So I will briefly address the loss. So they did take a loss in the quarter, and this is due to something that I sometimes refer to as pants on head accounting. Basically, some companies that have interest or majority interest in some subsidiary, what they'll do is they'll basically consolidate the whole thing and have the at market equity interest that they don't control be essentially liabilities. So this means that as the market price of the assets that they have goes up, their liabilities go up. So that basically the price of Melcor REIT going up is what caused the surge in their liabilities, which in turn caused the loss for the quarter. Dream, I felt, had a fairly unexciting quarter. Not terrible, not great. Overall, a lot of things in the pipeline, so hard to judge real estate based on one quarterly results of revaluation when, stuff finished or stuff is going to finish in a different quarter. Overall, I think the highlight of the earnings was that when they mentioned they expect to add $750 million in asset under management, which in the new impact fund, private fund, I believe they were talking about. Anyway, that's a lot of high margin fees that should be coming in by hopefully the end of 2021 is kind of what they put out there. I think that with Ontario in kind of the state that it's in, if we can get through this period without too much damage, that's probably a win, because the stock is not really expecting great things right now, even though the company does have a lot in the pipeline that should come to fruition over the next few years. Hopefully the damage done in Ontario in the meantime by this extended shutdown is not too bad. Share count was down 1.25 million shares, and they maxed out the normal course issuer bid. So, that's 1/44th of the company in 1 quarter, so you own more. So with Linamar, I think there was a lot of nervousness about chip shortages heading into the earnings session. I know certainly I was thinking, okay, well, this one might not be that great because of the chip shortages. Well, turns out they blew away at least my expectations because the brunt of the chip shortages is not going to be Q1, but Q2. So the impact there is probably delayed. I own the stock and I don't own it because of quarterly results or betting on quarterly numbers. Look, when I bought the stock, they kind of got themselves into an unfortunate position because they took on a bit of leverage at what proved to be not the greatest time. The thing is, now they've basically paid off all the leverage. And while it wouldn't surprise me if the stock acted heavy between now and them finally telling the market, okay, chip shortage resolved, it was this bad or this irrelevant or whatever you want to call it. But yeah, I'm not really expecting the stock to be a moonshot before it kind of proves that it can survive this, and I have no thinking that it's not going to survive this, just for clarity. But just the market likes to get the bad news in the rearview mirror and have projections going straight up and to the right. The most interesting thing about their call, on the earnings call, they spoke quite a bit about how their machinery is adaptable. And I don't know if I mentioned this before, I know I've heard it before, but basically they can take the machines that we're building in internal combustion engine parts and without too much effort, without too much added capex, swap them to building parts for electric vehicles. Or not. I mean, who knows what the future is going to be. But the point is, a lot of the sunk capex and the internal combustion engine industry going away, I mean, for them, it's not really a big deal. So their move into growing into electric vehicles, growing into fuel cell, if that becomes a thing, it's not that big of a capex shift, or it's not that big of wasted money in the past. So I continue to believe that this is a quality company, and as I said before, their net debt situation is all but gone, and the company now remains cheap versus itself and versus peers. Again, it's an opinion. Not to mention that I think it probably deserves or will deserve a bit of a re-rating higher as it diversifies into different sectors like healthcare, machinery, and out of strictly being an auto parts maker going forward. When I look at what's going on, although I see, everything's chip shortage concern, this, that, and the other thing, with the debt gone, with where we are, with how it's priced, if earnings start decaying, it's not like, okay, well, it's now going to take 4 years to cover the debt when we thought it was 1.5. It's like, okay, they'll make a bit less money. And that's kind of like, that's a worst case, not worst case, but like recessionary type scenario. Okay, they're making less money, so they're going up less quickly. Maybe there's some pullback or flattening or contraction due to earnings expectations, but honestly, the stock, it just is not expensive. And so I don't see a good reason why it should trade lower. And that's why I kind of mentioned recently, it kind of unenthusiastically sold a few puts, because if it does go lower, I still see it as a buy, even though it's had a bit of a move. But again, it's gone nowhere this year. I mean, this calendar year. So Aecon was a bit on the underwhelming side of the portfolio in terms of their earnings. However, there was a very large disparity between what you saw on the earnings numbers and the tone of the conference call. Now, there were a few wins that they mentioned that happened after the quarter, but I don't think the market was going to love the backlog drawdown. Now, they talked about how they're being disciplined and how they're looking for the right projects and not just trying to grow the backlog for the sake of growing backlog. But I think EBITDA was up less than what the market was hoping for, and the net loss was kind of, I don't know, a few people were disappointed. But overall, this is another business where quarter over quarter results can vary greatly in terms of the pipeline is not necessarily even. You can get more done in certain months, less in other months. Different disruptions cause different effects. But anyway, the numbers quarterly, I was not super impressed with them. But when I listened to the call, I was more optimistic for the future. But overall, it's not really surprising to me that Q1 didn't blow out expectations, just because we're still dealing with, well, not expectations, but didn't blow out last year, because we're still dealing with the hangover problems and the shutdowns and the delays and all sorts of related issues. And the concessions at the Bermuda airport still pretty much on hold, so that hasn't filtered through to the reacceleration that I was thinking would happen. So obviously, you know, it's traded down off the news, and I kind of think that at this point it's probably priced in the negative shock that some might feel. I didn't think, like, I think if you kind of, on the surface, the numbers, I agree, didn't look great. But the more I looked at it, the more I'm like, okay, it's the one-off quarter, maybe, hopefully, and things sound like they're going decently well. So I didn't buy this for a quarter. I think they'll turn it around. So I thought the results for Verde were pretty good. Volume was up 63% year over year, which is very good. Now, I will be the first to admit they still need a lot more scale. And also, Q1 numbers are basically irrelevant for the year. If they could do anything like this for the rest of the year, that would be pretty good. Spending was up too, so it was not a pure profitability boost in Q1. Hopefully, much of that was going towards investment to keep the growth over the rest of the year and expand capacity, because hopefully they'll need to do that too. I like the measured approach to guidance. After kind of talking things down a little bit in the last call, they kind of talk things up a little bit. Now, it's a bit of a measured approach. They raised guidance a little bit and kind of mentioned that, you know, if things remain this strong, they may have to revisit guidance again. The other thing I found interesting was BAX, so the new product. The sales on a trailing basis were less than 4%, and on a forward basis for sales, they are 14% as of now. So evidently that's something that customers are interested in. So I think prior to this earnings, many of the investors were kind of unimpressed with the targets set by the company. Hopefully this, along with the under promise, over deliver mentality, are able to materialize going forward for this company. We'll have to see, but yeah, the targets were not super to begin with, but raising them is a positive. So we'll have to see how the incremental growth goes, how the good quarters, or the quarters that hopefully are good, how they actually pass and take it one step at a time. Geodrill was probably the best of the bunch when it came to earnings, and the stock almost immediately reflected that. If you look at EBITDA of 10 million US for the quarter versus a $75 million market cap before the quarter, so 7.5 quarters worth of earnings, but also the estimate prior to that for this year, 2021, was that they would make 22 million. So they did almost half of that in one quarter. So of course, after analysts have been upping the estimates, I saw 28 million, I think, a few times approximately. So earnings up 30%, estimates up 30%, pretty good. The utilization rate was still 75%, which is not 100%, and there's new rigs on order. So I still think that there's room for more rigs to be used, and there's room for pricing to go up. So if commodity prices stay elevated, this whole sector really can do quite well, I think. So Global Atomic, note, I'm only putting this here because I know if I didn't, I'd get 5 questions about it at least. I wasn't going to put this here because it doesn't really trade off of earnings. Earnings were basically as expected, given where the pricing is and given what they kind of said last quarter. Bethesda's been pretty strong recently, so I don't know if that makes the zinc asset more valuable. Global Atomic remains my largest uranium holding. Another one, not exactly earnings, but Uranium Participation Corp. I think the Sprott announcement, while it may be good news for the Participation Corp, I think it's bigger news for the uranium market. Now, what I would hope as a UPC investor, I would hope that this Sprott change will give credibility to the NAV that Participation Corp has. So hopefully it will trade at NAV, whatever that will mean going forward. So I think that's the biggest deal here. It doesn't really have earnings to speak of. It just kind of has month-to-month kind of valuation shift. So again, not much to say here. Dynacore, not too much to say. Construction making progress on their upgrade. Capacity back up above 300 tons per day, which is, I think technically the nameplate is 300, but their capacity, they're processing 326 tons per day. So that's good. Only other comment, just running through the earnings, was that I feel like they have a bit too much cash on the balance sheet. If I was being critical in terms of, they should probably do some more with that. But you know, they were buying back shares a little bit. They pay a dividend. Maybe they'll increase that. Maybe they want to get a few other things out of the way first, a few capital expenditures. But yeah, so that's Dynacore. So Methanex saw a big increase in the pricing that they received, but they've still been having production issues in many places, and they're producing at a rate a lot lower than what they had planned to be producing in 2021 if you look back to, let's call it 2019. So mixed bag in a lot of ways there. Overall, though, the pricing is doing pretty well, and at this price, they can make a lot of debt disappear pretty quickly, honestly. And so liquidity on the balance sheet is one of the things that they were focusing on. And they also talked about the potential for methanol-powered shipping growth. So, I mean, big ships for transport, many run on bunker fuel or other highly pollutive mixtures. So methanol is I guess I would call it the natural gas equivalent. So there's potential growth there in terms of ships that would be more green. Arch remains a commodity price play on a commodity that has not really recovered as well as the peers, honestly. And so the main takeaway from the earnings here was Lear South, which is a new project, remains on time, on budget for production Q3. So that is the big thing going forward here. So an added thing, I thought it would be fun to cover the stocks I sold. Fun in that, not at all. So West Fraser and Stelco were both stocks that I sold in the past, were part of the portfolio. Sold because I felt like either there was better places for money or they became risky based on pricing. And of course, they are both rolling in the money right now. So that's great. Stelco, which was more recent, and I mentioned when I was selling it, it felt like a mistake. Why? Because my spreadsheet says it's really cheap. My mistake here was I wrongfully, I guess, assumed that the market took the 30 seconds it takes to copy paste the prices into a spreadsheet and look and saw, oh, they're trading at like 1 times forward earnings on an unsustainably high steel, but that's pretty cheap, but afterwards maybe not. So I wrongfully assumed the market knew this and didn't care, because what happened on Stelco's earnings at least was they basically said, guys, ladies, gentlemen, when we look forward, we could make more than $2 billion at this curve's pricing. And the market loved it, which is all sorts of odd because anyone can do that calculation. Anyway, I overestimated something. I don't know if I overestimated the market. I don't know if I overestimated analysts' work or overestimated my confidence in the situation. That didn't go well. Anyway, it's higher now. We'll see how that goes. And West Fraser is the other one. I sold because lumber was at an all-time high. Well, it's a lot higher now. And just goes to show you that prices can go a lot further than you'd think. But anyway, mistakes were made selling both of these stocks. I don't know if either of them will be a mistake in the end. Both were profitable trades, but when everything's going up, caution is a mistake until it isn't. And here's just to show a updated recap of the portfolio since the recent changes were made. Well, recent ones will be in the next one. The total gain number, that's kind of unfair in how they do it because the closed positions account for bump up the percent. But overall, pretty decent, I think. Then again, a lot of stuff went up last year, and I think Druckenmiller was quoted as saying, even a monkey could make money in this environment, and so I guess I did. And here, after the recent video, stocks I was buying in May, this is what 2021 looks like. More neutral, aside from Geodrill, which really I kind of lucked out on the timing of when I mentioned that was right before earnings that they happened to blow away. Was really strong earnings. Mostly this, kind of see my pivot to try and go to higher quality, less volatile names. Overall though, there's a dozen names in the disclosed portfolio. 9 are up, 3 are down. I'll take it. And I think that's just about it. As always, I hope you enjoyed, and this is not investment advice. And remember, this portfolio is not my entire portfolio and is just the timestamped as of when I mentioned it. So it's not everything and not actual size. That said, any commentary on any of these names or anything in the portfolio or anything you think is a great company that offers asymmetric upside that I might want to add to the portfolio is always welcome. I get some of these ideas from you. And with that, thanks everyone for watching, and until next time, have a great day.